Your money is losing value right now. While you're watching this, inflation is eating away at your purchasing power. In the next 9 minutes, I'm going to explain every single inflation concept you need to understand. Let's go. Starting with the absolute basics. Inflation. The rate at which the general level of prices for goods and services rises over time. When inflation happens, each dollar you own buys you less stuff. Your money loses purchasing power. Purchasing power. The amount of goods or services that one unit of currency can buy. If a coffee cost $3 last year and $4 this year, your dollar has less purchasing power. Consumer Price Index, or CPI, the most common measure of inflation. It tracks the average change in prices paid by consumers for a basket of goods and services over time. Basket of goods. A fixed set of consumer products and services valued on an annual basis. Think groceries, housing, transportation, and healthcare. The government tracks the annual cost of this basket. Inflation rate, the percentage increase in the price level over a specific period, usually measured annually. If inflation is 3%, prices are 3% higher than last year on average. Deflation, the opposite of inflation. When the general price level decreases over time, your money gains purchasing power. Sounds good, but it's actually dangerous. People delay purchases, expecting lower prices, which hurts the economy. Hyperinflation, extremely rapid and out-of-control inflation, typically over 50% per month. Prices double in weeks. Currency becomes worthless. Think Venezuela, Zimbabwe. It destroys economies. Disinflation. When inflation is still happening, but at a slower rate. Prices are still rising, just not as fast. If inflation goes from 5% to 3%, that's disinflation. Prices didn't fall, they're just rising slower. Now, what causes inflation? Demand pull inflation. Too much money chasing too few goods. When everyone has cash and wants to spend it, demand exceeds supply. Businesses raise prices because they can. Classic example. Pandemic stimulus checks. Cost push inflation. When the cost of producing goods increases, businesses pass those costs to consumers. Oil prices spike, gas gets expensive, wages go up, prices follow. Supply problems cause this. Built-in inflation, also called wage price inflation. Workers demand higher wages to keep up with rising costs. Businesses raise prices to cover higher wages. Workers demand higher wages again. It's a self-perpetuating cycle. Monetary inflation. When there's too much money in the economy, the government or central bank prints more money, increasing the money supply. More dollars exist, so each one is worth less. Basic supply and demand. Money supply. The total amount of money circulating in an economy, measured in levels like M1 and M2. M1 is cash and checking accounts. M2 includes savings and money market accounts. When this grows too fast, inflation follows. Quantitative easing, or QE. When central banks buy government bonds and other securities to inject money into the economy, it increases the money supply and lowers interest rates. Goal? Stimulate economic growth. Side effect? Potential inflation. Currency devaluation. When a country's currency loses value compared to other currencies. If the dollar weakens, imports cost more. Foreign goods get expensive. That drives domestic inflation. Your dollar buys less abroad and eventually less at home. How do we actually measure this? Core inflation. CPI, but excluding food and energy prices because they're too volatile. They swing wildly month to month. Core inflation reveals the underlying trend, eliminating noise. It's what economists watch closely. Headline inflation. The total CPI, including everything. Food, energy, all of it. This is what hits your wallet directly. It's what the news reports. It's more volatile but more real to everyday life. Producer Price Index, or PPI, measures inflation from the perspective of producers and manufacturers. It tracks the prices businesses pay for raw materials and inputs. PPI often predicts CPI because business costs eventually reach consumers. Cost of living, the amount of money needed to maintain a certain standard of living by covering basic expenses, housing, food, taxes, and healthcare. When inflation rises, the cost of living rises. Your same paycheck buys less life. Cost of living adjustment, or COLA. Automatic increase in wages or benefits to keep pace with inflation. Social Security uses this. Some employers offer it. If inflation is 3%, your Social Security check increases 3%. It protects purchasing power. What does inflation actually do to you? Real versus nominal value. Nominal is the face value, the number on the price tag. Real value adjusts for inflation. If you got a 2% raise but inflation is 3%, your nominal wage went up, but your real wage went down. You're actually poorer. Real interest rate. The interest rate is adjusted for inflation. If your savings account pays 2%, but inflation is 3%, your real interest rate is negative 1%. You're losing purchasing power, even though the number in your account grows. Wage growth. The increase in worker pay over time. Sounds great, but it only matters if it beats inflation. If wages grow 4% and inflation is 5%, you got a raise and still got poorer. Inflation expectations. What people think inflation will be in the future. This matters because expectations become self-fulfilling. If everyone expects prices to rise, they spend now, driving up demand. Businesses raise prices preemptively. Boom. Actual inflation. Stagflation. The nightmare scenario. High inflation combined with stagnant economic growth and high unemployment. Prices are rising, but nobody's making more money, and jobs are scarce. It's the worst of both worlds. The 1970s were brutal because of this. So how do we fight inflation? Monetary policy. Actions by a central bank to control money supply and interest rates. The Federal Reserve uses this to fight inflation or stimulate growth. It's the main tool governments use to manage the economy. The Federal Reserve, America's central bank, it sets interest rates, controls money supply, and tries to maintain price stability and maximum employment. When inflation spikes, the Fed steps in. Jerome Powell is the current chair. Interest rates. The cost of borrowing money. When the Fed raises rates, borrowing gets expensive. People spend less. Businesses invest less. Demand cools. Inflation slows. When they lower rates, borrowing is cheap. Spending increases. The economy grows. Inflation target. Most central banks aim for about 2% annual inflation, not zero. A little inflation is healthy. It encourages spending and investment. Too much is dangerous. Too few risks deflation. 2% is the sweet spot. Price stability. When inflation is low and predictable, typically around that 2% target. Prices aren't frozen. They rise slowly and steadily. Businesses can plan. Consumers can save. The economy functions smoothly. It's the goal of central banks. Inflation hedge. An investment that protects against inflation by maintaining or increasing value as prices rise. Stocks, real estate, and commodities like gold. When cash loses value, these tend to hold value or grow. That's how you fight back. Tips. Treasury inflation protected securities. Government bonds are designed to beat inflation. The principal adjusts with CPI. If inflation rises, so does your investment. When TIPS mature, you get the adjusted amount. It's guaranteed inflation protection from the US government. There you go. Every major inflation concept in 10 minutes. You now understand what's happening to your money and why everything feels more expensive. Because it is. If this helped, hit subscribe. Drop a comment with the term that surprised you most. And if you want to know how to actually protect your money from inflation, let me know. Next video, we're explaining every stock market term you need to know. See you there.